Yes, how we doing, everybody? It's John with Elixir Residential, or you might know Elixir Property Holdings or Elixir Construction. It's a little bit later in the evening. I have some extra time, and based off of the number of deals that I've analyzed over the years, I wanted to go over some portfolio building parameters. So some of the things that I've learned over acquiring, over 50 uh, assets, single family homes, small multifamily, specifically for the purpose of yield. So basically, it's a yield portfolio. And we know that yield is basically for what we have into a property, what is it yielding in cash flow? And um, within this asset class, so that's single families, small multifamilies, most of the time we worry about gross yield. So that's a total of the revenue or rents that are generated off of a property and base that off of the capitalization, i.e., so we have gross yield, and that's equal to sum of rents, and that's coming from leases, or leases, lease property. Okay, and then we have capitalization, and capitalization at the end of the day is the cost to purchase. So purchase cost plus improvement cost. Those are kind of the big factors that go into the capitalization of an asset. You have your original price to acquire it, and then the cost to stabilize it and have it ready for tenants to generate revenue. Some things that are not always included in capitalization, but could be like transactional costs as well. But just for simplicity, there's obviously some adjustments. This is a gross calculation after all, so adjustments can definitely be made for if you're worried about net. But like I said, when it comes to building a portfolio, you're analyzing hundreds of properties, trying to make sure it fits with the parameters of the portfolio and it's going to help you reach your goals. A lot of times, gross is just fine. That's just the first step to underwriting, or kind of like high level portfolio parameters. From there, there's very intensive, property underwriting and expense underwriting, improvement underwriting. So there's a lot that goes into it. But so you have your yield portfolio, gross yield, capitalization. So yeah, you end up with a yield, right? So just want to go over a deal we were looking at today, and just take a look at how how the underwriting worked, and why we made a decision to basically not buy the property or stick at a lower number that we need to be at. So the property overall was we have beds. Let's see, beds, baths. Property was basically five bed, two bath. The square footage was about 2,800. It was a pretty large building. And again, like if our goal for yield, if we want to get into yield, we might set a target yield. Okay, so before we go any further in this, you need to understand kind of the lens that we're looking at this through, because we can talk about these numbers all we want, and these just change deal by deal. But at the end of the day, what doesn't change is your yield requirements. So we might say that we would like a gross yield target. Excuse me. and we're going to have our target for gross yield be equal to 20%. Okay. So with this property, we need to, the beds, bath, square footage, and then it's actually, and then we can have rents right here. So it's a duplex. So we just say unit 1, unit 2. Unit 1 was bigger, so we were anticipating like 925 in rent. Unit 2 was smaller. We were anticipating more like 750 in rent. So the total for the rents for the month is 925 plus your 750, and then we need to take that number and multiply this by 12 to get our total annual number. So yeah, there we go. So about 20,000. Like I said, at the end of the day, this doesn't really matter. We're just trying to back into a yield target. So basically, the inverse metric that is, like I said, the inverse of a yield target is a multiple, and so it's a gross rental multiplier. So a gross yield target of 20 is 5, and basically the way that we get this is we just divide this number divided by 1. So really this is 20%. We do 0.2. Or really 1 divided by. So 1 divided by the gross yield target gives you the gross rental multiplier. So, we can have 0.21, 22, and so on and so forth, but you can run some calculations. So basically what you can see here is the more money that it generates per dollar that you have it capitalized, the lower it's worth when you go to multiply the total rent out. So we said our target is 5. Okay, so we know that we want to capitalize. We're just going to call this target cap. So our target cap is our total rents times our 5. Okay, so this is what we need to have into the property in order for it to fit with a 5 rental multiplier or a 20% gross yield target. So we need to be all in this property for basically $100,000 in order to have it fit these parameters. So, okay, maybe I can make this a little bigger. Okay, so maybe, from there we have the budget to stabilize. So like we were talking about our capitalization, if our target cap is basically $100,000, we need to subtract out the improvement costs, and then that will tell us what we can afford to pay for the property if we want the numbers to work. So we found out the budget was $34,000, and that means that our target, we're going to call it PP for purchase price, is our total cap minus our budget is 66.5. Okay. So this is the number that we'd want to be at if we wanted to make this work within these numbers. So, and I think what's interesting and something that you can extrapolate from here is, okay, this is looking at this deal from a yield standpoint, but it's hard to ignore, and this is where it takes some experience to really get to understand the asset class and the type of real estate that generates these kind of returns. One thing that would stand out right away is, even is the cost to acquire. The cost per square foot for ACQ to acquire the property. So that would be our 66,000 divided by our 2,800 square feet. So our cost per square foot to acquire this property is $24 per square foot. Wow, right? So if you have been paying attention, or basically know the first thing about replacement costs and the cost to build new construction real estate, it's 10 times this amount. So if you're buying it at basically 10% of the cost of replacement, and we're thinking, great, right? If the cost per square foot for it totally capitalized is going to actually be equal to our target cap divided by the same number. So it bumps it up to $36 per square foot. We'll just say full cap. Okay. So, as a percent of the cost to replace, it's like 10%. So what you have to watch out for in deals like this is having really strong budget underwriting and understanding the underlying assets and the cost to maintain them, as well as the cost to improve them, which is what we talk about. So really, it's already a crazy bargain at $24 per square foot or $36 per square foot. But what we have to keep in mind is this is a big building, and big buildings cost a lot of money. So even though it's generating the $1,675 per month, what does it actually cost to maintain and ensure that the property is stabilized and able to generate this income out into the future? So that's something that you would have to be aware of, because on paper we could do this deal and it would make sense, and we could probably get renters into the building and get some leases and start generating income. And for a while, this property would meet the return characteristics that you're looking for in a income property portfolio or income producing real estate portfolio. The issue with this is that the cost to keep up with a big property like this is substantial. So on this opportunity, it came down to the overall condition, and the big thing on deals like this is going to be exterior. So it kind of comes down to how well or not well the previous owners had maintained the property, and there's a massive deferred maintenance factor in deals like this. So on this deal, it had older siding, the exterior was worn, it had 23 larger old windows that all need to be replaced. The building really wasn't stabilized. Plumbing issues throughout the building, electrical issues throughout the building, and if a property is really neglected for a number of years, even though we can probably get it stabilized for this number, there's still kind of like a phantom deferred maintenance number hanging over this property. Where, right, if we capitalize it for this 100 grand, maybe we can get an appraisal for where this number is 70% or 80%, between 65 and 80% of the appraisal. So while we could probably even get it to appraise for the 130 or 140 grand, having this massive deferred maintenance kind of like phantom expense hanging over the property is something that, despite probably getting an appraisal for like a refinance appraisal, despite the ability to get a refinance appraisal, there is going to be an issue with marketability. So there's going to be issue with marketability. So because your local pool of buyers is privy to this, so it's all great if you can buy this property. The issue is that you need liquidity to exit. And if you are stuffing your portfolio, because these numbers look good on paper, $24 per square foot to purchase it, it's stabilized without factoring in deferred maintenance for 36 bucks a foot, and we are making tons of money, 20% gross yield. You already, basically you already know that if you're filling a portfolio up with properties like this, you have to be aware of the liquidity that is going to be purchasing these properties when it comes time for you to transfer up or out of a portfolio like this. And really, for a local, seasoned, knowledgeable, and experienced investor, we would know that a 2,800 square foot duplex is not really ideal, because we can get one for our tenants at 1,000 square feet less. They still get a pretty adequate sized apartment for what is standard in the market. So if it's 1,800 square feet, we can rebuild. I could rebuild this deal into something that we want to see, which would be more like this. So I'll just recreate this, and then we'll go ahead and end this video. And thank you guys for paying attention. So let's just say that it's still a 5-2. So it's a 3-bed. It's a 3-bed and a 2-bed, and so it's a 3-1 and 2-1 are the units here. But instead of 2,800 square feet, we have 1,800 square feet. All right, and so I'll just say that the 3-1 we'll say is 1,100 square feet, and the 2-1 is 700 square feet. These numbers are totally in line with what is available in the market and what people come to expect when they see a 3 or 2-bedroom apartment in this local market. So with everything like that, we might expect to see a slight decrease, but nothing too major on this. So we might get maybe 900 for that unit, and maybe 700 for this unit. So the rents go down, but not by that much. And so we are, and it's still calculating. So it's saying that basically we can buy this same property, even though. So right away in the analysis, you can see how this just restructuring this into something that would make sense is we can basically eliminate, right? If we do our 1,800 divided by 2,800 is 65% of the size. We can eliminate over a third of that potential deferred maintenance and only reduce our target purchase price by a couple of $1,000s. When we're talking about, remember, we're talking about 1,000 square feet with a replacement cost of 250. Okay, so this is where you can start to understand that we just eliminated basically $250,000 worth of potential deferred maintenance, because if we can get the property's condition to very minimal deferred maintenance, that is as close to as an equivalent of new construction as you can get. And that's the way that appraisers rate conditions. So it kind of has to do with the level of all updates, but also deferred maintenance. So something with no deferred maintenance is practically new. So we're eliminating, over a third of the square footage, which is going to reduce that potential, like kind of outstanding phantom expense, phantom liability of this deferred maintenance. And we only need to reduce our offer price by $4,000. So I don't know about you, but I would love to, not be responsible for $250 extra $1,000 worth of building to maintain and worry about not becoming, getting to a point in its condition where it's causing immediate requirements for expenses. That's what we're talking about here, right? So bigger roofs, bigger, the bigger the building, the more expensive it is when you are forced to make a repair because of excessive deferred maintenance. So it might not be 250,000 exactly saved, but that is going to eventually trickle down into that immediate expense, which you don't have a choice to address because it's occupied, and you're not running a slumlord portfolio, right? So it's just drastically reducing the potential for a larger expense because the building is just smaller. And also when it comes, when we need to do the update the siding or replace the roof or replace windows, we don't need each unit to have 12 windows, right? Like some of these older assets were built, you know, in a way that's not really consistent with what the market can bear at this, in the rental market in certain urban areas. So efficiency needs to be kept in mind. A lot of these properties when they're built, efficiency and cost to maintain is changed drastically over the last 100 years in a lot of these Midwest or just like I said, urban areas. So, I don't know about you, but reducing this potential exposure by this much is enough of a win in and of itself. But also mention one other thing that reason why I like this deal so much better right here is it comes down to the tenant, right? So you do your best to screen tenants. You do your best to keep your units full. But at the end of the day, people have a year lease, year and a half, 2 year lease, whatever it is. When they go to move out, if they have, that's just even more of that space is just even more of a potential uh, cost for that tenant to keep up. Then if that tenant can't keep up with maintaining that extra 1,000 square feet that you have in this in the first building here, then that falls back onto you as a property owner when it comes time to turn it over. So bigger units are just more expensive to turn over, and I would rather have a smaller unit that's cheaper to turn over and give up a few, 50, $70 a month in rent than, like I said, in this deal, have just kind of this massive potential for heavier turnovers and expensive repairs to address deferred maintenance. So, it's just something to be careful about when you're underwriting deals, and why some deal like this one might seem attractive, especially if you push these rents more and got more aggressive. But at the end of the day, it's almost impossible to justify taking any more money in rent to have additional deferred maintenance over your head and just a larger asset to maintain when the goal is to, have a property that spits off cash, right? It's just not consistent with the strategy of yield, which is generating cash. It's not consistent. So, yeah, just wanted to kind of capture this underwriting, and appreciate everybody for tuning in. Good luck building your portfolios. And if you have any questions about building portfolios or anything else, feel free to reach out. Thank you for tuning in.